Hello, everyone. First, thank you so much for having me. Penn was my alma mater. I was not a Whartonite. I was a poli-sci major in the College of Arts and Sciences, so this was kind of the Death Star to us back then. I did take a few business classes in this building and very much enjoyed it. My poli-sci degree turned out to be almost weirdly useful within this context. And it wasn't so much the specific facts that I learned, as it was just that framework that so much of what we're now obsessed over is regulation. A key theme in cryptocurrency and crypto assets since their launch has been, I'll use the term reflexivity. So George Soros expounds a lot on the concept of reflexivity, which is kind of this circular effects within markets on human behavior that then impacts markets. So we see that with regulation, which is regulators didn't care about cryptocurrency when it was tiny. Then you get a parabolic advance. It starts getting used for something. They find that threatening, and they smack it down. So a couple of years ago, China, Bitcoin was taking off in China. It was being used a little bit to evade capital controls, but it was generating a lot of excitement. The Chinese regulators became fearful of it. They somewhat banned it. The Bitcoin price crashed. Now we've just kind of gone through that a little bit in the US, South Korea, and Japan. Central bankers aren't yet worried. So some Federal Reserve bankers testified before Congress that it wasn't yet big enough to threaten central bank monetary policy. But the SEC is concerned because cryptocurrency fundraising for new startups actually eclipsed the venture capital world in the last 2 quarters. So that framework of kind of thinking about the political realities and how regulators will respond and trying to forecast this kind of interesting reflexive cycle, I'm getting to put my degree to work a little bit. So the big picture with cryptocurrency is no one owns any. So there's maybe 60 or 70 million owners of crypto assets in the entire world. And really no one uses it. So there's maybe something like 3 to 5 million active users of cryptocurrency. And by usage, I mean anything other than pure speculation. So people who are using it on darknet markets to purchase illicit substances, people who are using it to repay a friend after a night at the bar, people who are using it, even for people who are using it to fundraise via initial coin offerings, which many have argued is kind of the current killer app of cryptocurrency. Its killer app right now has been fundraising. Even with all of that, you're looking at a very, very small number of active users, almost a trivial number. And I think that's really useful to keep in mind. The title of this talk, which was suggested by the conference organizers, it's funny. I tend not to think in those frames. And in fact, when I was invited to speak here, we were probably closer to the bubble phase, which was when Bitcoin was at around 17,000, I think. So we've since had a 70% crash in Bitcoin, an 85% crash in most other things. So kind of between when I was invited and when I'm talking now, we've maybe shifted from one to the other, or at least I should say from bubble to burst bubble. But it's useful to keep in mind that however exuberant the market felt, however parabolic it went, no one owns any and no one uses it. So we're still in the very, very earliest stages of adoption of this technology. And also the earliest stages of adoption of this as an investable asset class. So how should we think about it kind of on an adoption curve? Where is it, right? So if no one uses any now, well, how many people will use it in 5 years? How can we think about where we are along this process? So no mental model is going to be perfect. No analogy is great. But the one I use is kind of the internet boom, partly because at least I was alive for that one. Going back to the railroads, the 1800s is harder. And as I was kind of rereading the history, because I was in high school basically during the tech boom, what amazed me was just how fast it happened. So in the early 90s, very, very few people used even email. The internet didn't really exist. So here's kind of the very brief history. Email was created, if you had to pick a date, maybe 1971, by ARPANET engineer Ray Tomlinson. For the next 20, 25 years, the only killer app of the internet was email. It was the only application that anyone used on the internet. And even that wasn't used by very many. So until the mid-'80s, almost no one used email. It was a toy for a small number of engineers. By the mid-'80s, you had some big US companies using it. By the late '80s, you had kind of maybe 10% of US companies that were large using it. But still, you didn't have retail usage. You didn't have companies outside the US using it. Even in 1993, 10% of Americans had internet access and only 1% of the rest of the world. That was 1993. In 1993, there were 200 websites. In 1994, there were 2,500. It wasn't until 1995 that the average person kind of could access the internet. That was the year Netscape Navigator launched. Before 1995, you didn't really have a web browser that was accessible to the average person. So the first website was born in 1991. but literally no one, I mean, unless you were an engineer, you could not visit that website. And in 1993, you had people launching things like, actually I think it was 94, someone launched an online video streaming website to stream sports. Well, everyone was on AOL dial-up, so that didn't work out very well. And when I say everyone, maybe 2% of Americans were on AOL dial-up, right? So you had no consumers, you had no users, and those who were users didn't have the bandwidth to download what you were offering. Another good example from that period was of those kind of 2,000 websites or 2,400 that launched in 1994, another was, for example, online retailers that would try to sell you, say, jeans and mail them to your home if you entered your credit card data. Again, those companies generally failed. Obviously, that's a great business model. Many, many successful companies today that do that, but it was too early. So you didn't have credit card payment processing that was trusted by consumers. Individuals weren't going to enter their credit card info over the internet. And again, only 10% of Americans even had access to the internet. So you had this tiny sliver of potential consumers. So the reason I'm giving you this kind of brief history of the tech boom is because I think it very much applies to how to think about investing in cryptocurrency today. This is very much like 1995. So we're seeing a lot of brilliant projects that I think are a lot like online video streaming in 1995, or they're a lot like that kind of direct-to-consumer, purchase jeans online, which is to say they're great ideas, they make a ton of sense, but you don't yet have the users, the potential consumers, and you don't yet have the infrastructure to support these ideas. So I'm starting the talk on a pessimistic note, but I promise that will change. I am very much a believer and an optimist and very excited for what's happening. So some of these projects, for example, you look at decentralized applications. That's a term that just means applications, like anything, I mean, any kind of application that runs on a computer. You could think of it as Facebook or a game, and except instead of being controlled by one company or run on one server, it's decentralized. And decentralized can mean some different things, but probably it means public, open source, can't be controlled, anyone can access it. And the problem is right now there's so few potential users for those decentralized applications. We lack the bandwidth. So similar to 1995 when everyone was on AOL dial-up, we're kind of on AOL dial-up with blockchains right now. So projects like Bitcoin can only support about 14 transactions per second. And someone who's going to be on stage after me, Elizabeth Stark, is working to fix that very, very quickly. But we're still at the stage where, or you look at Ethereum, which is also around 14 transactions per second, you don't yet have the infrastructure to support meaningful throughput that's required for a decentralized application. So a lot of the projects being built on top are going to face much longer delays, I think, than a lot of the kind of the bulls hope. Like that online video streaming site, it might be 5 years away from actually having the infrastructure necessary to support what they're trying to do. With all of that said, I'm very, very excited for the next 18 months because no one uses cryptocurrency right now. And by no one, I mean a few million people. I think that's going to skyrocket. And it's going to skyrocket for a few very specific use cases that the technology is finally mature for. So to introduce another framework, you guys are probably familiar with the Gartner hype cycle. And if you're not, don't worry. Really, really simple concept is just a new technology gets introduced. People get really, really excited about it. They correctly say this is going to change the world. You get a massive bubble in asset prices. And then people realize, OK, this is actually going to take 10 years. Engineering is hard. Getting consumers to adopt new tech is hard. Figuring out the right use cases, the right killer apps is hard. And it takes a lot longer than people tend to anticipate. So then you get a bubble burst. You get a trial of disillusionment. And then usually 5 to 10 years later, you get those killer use cases. So the tech boom was kind of a classic case that we're all familiar with, where those companies that launched in 95, 96, 97, even the pets.coms, they were early. But in another 5 years, Ask Jeeves kind of died, but you then got Google, right? And we got Amazon, kind of, which existed before the tech collapse, but didn't really take off until after. Until after you had more users, more consumers, more infrastructure, more bandwidth. So where are we on the right side of the Gartner hype cycle? So Bitcoin went through a previous Gartner hype cycle with P2P payments. So 4 years ago, the Bitcoin bulls, the fans, were saying, we're going to be buying coffee with Bitcoin tomorrow. Bitcoin's going to put Western Union out of business. Bitcoin's going to put credit cards out of business. It's going to put banks out of business. And it was just way too early. As a technology at the time, it was able to support more like 7 transactions per second. You didn't have a user base. Using it was very hard. You almost had to be an engineer using a command line interface to really use it. Security was tough. There's no custody. You had all of these obstacles, and we'll dive into them a little bit more. I think we're now on the right side of that. So we have bandwidth increases that are on the horizon over the next 12 to 18 months. There's a lot of competing technologies. Lightning Network is one such possible solution that sits on top of Bitcoin and enables much faster, cheaper transactions. There are also other competing technologies. And I'm not just focusing on Bitcoin. Bitcoin is just kind of one of the leaders. But these technologies to support just more transactions in a decentralized way are kind of finally here. The user interfaces are finally here. So Coinbase kind of conquered the world, at least the cryptocurrency world, became a billion-dollar company, mostly because they offered a user interface that non-engineers could use. Something I'm very excited for as an investor in the space is custody solutions. So right now, basically everyone in cryptocurrency has to self-custody the assets. What that means is if you're, say, the Winklevoss twins of Facebook fame, who were very publicly Bitcoin billionaires, they travel with a lot of armed security because they themselves control the Bitcoin. And they say that they have this complex mechanism of splitting up the private key, but there's a concern that, you know, if you have a billionaire like a Ray Dalio, if you were to kidnap him, you don't get his billions. His billions are secured by prime brokers or equity ownership or whatever. With cryptocurrency today, it's self-custody, meaning the individual probably has control of those assets. We're moving away from that very, very quickly. A year ago, there was very little demand for third-party custody. There were not many people offering to pay. Now I get up and stand at a conference and I say, I'll give 3% of my AUM every year to a third-party custodian because we're desperate for it. Regulations require it, and for security reasons. So a really kind of one of those other major hurdles to adoption is custody. Another is security. So you have massive numbers of engineers leaving Google and Facebook and hardware security experts working on making, for example, a smartphone app that can securely store your cryptocurrency in a way that you might trust with at least a few $1,000s. So all this is to say that I'm optimistic that in the next 12 to 18 months, we're going to start seeing the first real usage of cryptocurrency, probably for just a couple use cases. So probably nothing that sexy just yet. Probably what we're going to see adoption for, I think, is the initial vision of Bitcoin was as a kind of what PayPal wanted to be. So PayPal was supposed to be P2P cash that was censorship resistant, meaning there's no third party, there's no bank, there's no government that can censor it. PayPal certainly didn't turn out to be that. It's a centralized company. The vision for Bitcoin was that if you're in Venezuela and you want to send money to a family member in Argentina, that you can, and that no one can stop you, that your totalitarian government can't stop you, maybe even your liberal government that imposes capital controls can't stop you, a bank can't stop you. And I'm framing it in terms of resilience in the face of banks, but this can also just be, we have 1 billion people around the world who can't get bank accounts. So in America, we kind of take for granted that we have Venmo and PayPal and credit cards and bank wires that work reasonably well. A lot of people around the world don't have that luxury. So I'm very excited that I think soon we're going to have cryptocurrency as P2P payment. The other use case that is kind of ramping up is as an investable asset class. So I talk constantly with family offices, endowments, and pensions who say, this is really interesting. We have assets that some of them act as commodities. So Bitcoin you can think of as digital gold. It's depreciation resistant. Unlike the US dollar or the yen or the Swiss franc, a central bank can't print more of it. It hasn't really been a good store of value because it's been hyper volatile. But some institutions are thinking this might be an interesting diversifier in our basket of a portfolio similar to the function of gold. And then you have many crypto projects that are more like venture capital. They're more like equity. And they're potentially like hyper growth equity because you have potentially an investment. A good analogy that people often use is imagine if Facebook users also owned equity in Facebook. How quickly would Facebook have grown if not only would you invite your friends to Facebook because you wanted to have your friends on the platform, but if every time a friend joined, your equity also appreciated in value. So some of these crypto assets, some of these projects are a little bit like network effects on steroids. And that's also very interesting to investors who are kind of looking at subpar returns. So I realize that I'm talking to a group of business people, MBA students. I very often am talking to either kind of asset allocators or developers. What's on many of your minds is probably kind of how do you get into this field, especially for those of you who are non-technical. So I myself, I'm not a cryptographer, I'm not an engineer. It wasn't, in crypto terms, things move very quickly. So I was going to say it was a long time before I felt comfortable kind of being in the space. Really that long time was maybe 3 or 4 months because things move fast. But so how can you kind of add value? Where's your place in this world? So I talked about kind of this lack of infrastructure being a major impediment. The crypto world needs more engineers, more cryptographers desperately, but it also needs people. What's amazing to me is a lot of those people don't appreciate the role of business development and marketing and user interfaces, and also just all the things that go into building a successful company. So what's going to enable this next wave of growth, of retail adoption, of institutional adoption, is people like yourselves who are interested, who learn about the technology, but who also bring kind of the business skill and business talent. So I talked about, for example, those custody solutions. The custody leaders are either banks or potential banks that are looking at getting a banking license or a custodial license, or projects like Coinbase they're going to partner with banks, and they're now kind of doing business development to onboard institutional investors. They're trying to understand customer pain points and improve their customer service. A good line with the internet, in the early 90s, there were people who said, the internet's never going to take off, it's never going to be a retail product or retail accessible, because there are all these obstacles. So no one's ever going to trust the internet with a credit card number. The user interfaces are terrible, the bandwidth's too low. And every obstacle that you could have thought of as to why people won't use the internet became a billion-dollar company. So whoever solved kind of installing credit card processing into a backend into a website easily, that was a billion-dollar company. And whoever created, spin up a website in 30 seconds, that became a billion-dollar company. And all of these things. And I think in cryptocurrency, we're seeing the same thing right now. And that's the mindset that I would encourage you to take. So if you tell your friends, hey, I'm interested in cryptocurrency, and they say, that's never going to work because, that because is a startup that's going to become $1 billion. So the ones that are happening right now, where if you were looking to get a job right now on kind of the business side, the ones that I would recommend that you join are the people solving the custody issue. So there's some big companies, like Ledger is one. Let me rephrase. There's custody on the security side, and customer service and hardware development side, and then there's custody on the legal regulatory side. And they're both important. And I'm not sure if the winner is going to be kind of an organic company that does both, or if we're going to see mergers. So for example, there was a tech company called BitGo that did the security side, and a bank called Kingdom Trust, and they've now merged to offer kind of a full suite custody solution on both the tech and regulatory side. And I'm not telling you who's going to win, but that's a great place to look for a job in an ultra fast growing kind of space. Another are markets. So right now, cryptocurrency markets are heavily manipulated. It's fly by night. Most of the billion-dollar exchanges that exist today, they were started by people in their mid-20s or late 20s who had the thought of, hey, I'm going to spin this up kind of out of my basement. And they just grew far faster than anyone expected. So you may have heard of Mt. Gox, the disastrous exchange that collapsed in 2013. There was fraud, there was insider trading, there was market manipulation. Mt. Gox stood for Magic the Gathering. It was an exchange that was created to trade Magic the Gathering cards. And in 2013, there was no one interested in creating an institutional quality exchange. There was no money in it. And so the Magic the Gathering site added Bitcoin as a little add-on, and then very quickly was doing multi-billions of dollars of Bitcoin trading and earning incredible revenue, and income, by the way. So it became an incredible business overnight, but the people running it had no idea what they were doing. So we're still kind of in that place with a lot of the exchange infrastructure, a lot of the fiat on-ramps. And it's professionalizing right now, and there's massive demand for hiring because of that. So for example, Square, run by Jack Dorsey of Twitter fame, is now integrating cryptocurrency as a fiat on-ramp to let individuals buy it. Circle is another payment processor that just purchased a crypto exchange called Poloniex. All of those groups are hiring like crazy because they have more demand than they know what to do with. Coinbase was adding, I'm not sure what the number is now, at their peak they were adding 40,000 new accounts a day. And the biggest complaint about Coinbase was their customer service stunk because they couldn't service that many accounts. And they were hiring as quickly as they could, professionalizing, bringing in people with Wharton degrees like yourselves. I'm not sure what the next wave is going to be. Obviously, I don't want to recommend that you kind of chase the last thing. But I think, thinking about what those pain points are, thinking creatively about, and really asking, like, okay, why aren't people using cryptocurrency? What are the obstacles? So some of the areas that I'm looking at, for example, on what is an obstacle to that P2P rail is, well, you need people to be able to buy the cryptocurrency easily. So it can't require buying Bitcoin on Coinbase, transferring it to another exchange, and then buying some other crypto asset. Another issue was stability of price. Right, so Bitcoin fluctuates like crazy. That's hard to use with merchants. So there's a number of potential kind of solutions for that. Something called a stable coin might work, which is a peg to the US dollar, or peg to CPI, or peg to gold, but there are other ways to tackle it. You could, for example, use financial derivatives to do a swap on Bitcoin that merchants can use. So there's potentially solutions there. You need people to trust that they're not going to be hacked or have their money stolen, so that there's both a hardware challenge and a software challenge there. And then you need people who know how to market and growth hack. So cryptocurrency, until very recently, didn't really have kind of the marketers that we know and love from whether it's Yelp or any of these consumer companies, those people are now getting into the space. There's tremendous demand and there's tremendous value. So one example, Telegram, you guys probably know the app on your phone. They just raised $2 billion to then create a cryptocurrency. And the reason they were able to raise so much money and that investors were so excited is because they have 200 million users. And that means if they airdrop this cryptocurrency, and airdrop is where they just give all of their users some tiny amount of cryptocurrency, on day one, they will have more users than Bitcoin and every other crypto asset combined. So that level of kind of growth hacking or marketing, how do you scale a business incredibly quickly? There's huge demand for that kind of throughout the entire crypto asset world. The last topic that I'll touch on is back to kind of the area that I know best, which is the investable, cryptocurrency as an investable asset class and where the space is there right now. So I mentioned that no one owns any, 60, 70 million people. About 1 in 3 South Koreans own cryptocurrency, so it's very kind of chunky. So a decent number of Americans, I can't get a good number, a good estimate, but maybe something like 5%, 30% of South Koreans, a reasonable number of people in Japan, and then very little in most of the rest of the world. The boom in 2017 was mostly US retail and South Korean retail. Wall Street individuals have invested in the space. So for example, people like Stevie Cohen didn't own any cryptocurrency at the start of 2017 and now personally own a ton. In the endowment world, every single top 10 endowment has quite a few employees who own cryptocurrency, many of whom, I know a CIO of a top 5 endowment who made more on Bitcoin in the last year than he made in his salary for the last decade. Their institutions are not in yet. The reason they've been underwriting, they've been talking to funds and talking about potentially passive investment, and they're not in yet for those kind of reasons I described. So the lack of custody, the lack of regulated exchanges, the threat of the concern over market manipulation. But they're moving as quick, but they want to get in because alpha is hard to come by in the investable universe. Everyone's looking for an edge. Everyone's looking for a way to hit their higher return bogey. Pensions definitely won't get in until there's third-party custody. So I think pensions are probably a year away. Sovereign wealth funds have been dabbling. So for example, the Singapore, I forget the formal name, but the Singapore Sovereign Wealth Fund has made large purchases of Bitcoin, large for the Bitcoin market. I don't know about large for Singapore. And we're seeing kind of growing interest globally with the main stopping point being regulatory uncertainty and all of these kind of infrastructure issues. So on the regulatory front, regulators have been pretty clear. There's a lot that's ambiguous, but there's a few things that are very clear, which is crypto assets are supported in a very positive sense throughout most of the world. South Korea, Japan, and the US. So for example, Giancarlo, who runs the CFTC, has said he encourages his children to mine Bitcoin. They're very, very constructive on crypto assets. What they've said is they're going to enforce existing law. So in South Korea, for example, 2 weeks ago, there was a raid on a bunch of the leading South Korean exchanges because it turns out those exchanges were engaging in explicit fraud where they would steal customer deposits and use them to gamble on other exchanges. Similarly, in the US, there's now threats going against some of the leading, or I shouldn't say leading, but some of the large exchanges. And those threats are, hey, you guys are trading securities and you're not registered. So FinCEN said you have to register with us because you're trading securities. Similarly, the IRS has said, hey, exchanges, you have to report taxes to us. So it's just enforcement of existing laws. And the problem is a lot of these exchange operators and crypto companies are kind of run by kids. And I mean that semi-pejoratively. Some of these are brilliant entrepreneurs, but they don't have a team of regulators, they don't have a team of lawyers. They have no idea how to kind of meet these requirements. On the ICO side, initial coin offering, the issue is basically that they're probably securities, or at least many of them are, or some of them are, and we're not sure which ones are. And regulators around the world have said, if they're securities, we regulate them as securities. So there's a lot of gray area. Regulators are very constructive on crypto assets that are clearly not securities. But there's been so much back and forth on this that a lot of the institutional investors, including the retail investors, just feel like there's this tremendous uncertainty. So I'm also optimistic in that regard. It's going to take us a long time to actually probably write new laws eventually. Things will get tested in court. The SEC will bring enforcement actions. Some of those they may lose in federal court. Congress will probably pass new laws. All of that's going to take years to play out. But I think over the next 18 months, we'll have a lot more comfort on where the gray area is. Right? So it'll be clear that this category, for example, of operating, of doing what Square is doing and allow customers to purchase Bitcoin, can be done in a totally regulated, legal, transparent way. I think that's roughly my time. Let me end with kind of one parting thought. I guess trying to tie it back to boom or bubble. And I realize I was very much in the weeds because you guys have had a full day listening to a lot of wonderful, wonderful speakers. I didn't want to be too high level. But I think my conclusion here is, so cryptocurrency, it's not really an asset class. It's not really a technology. It covers a huge kind of breadth of things. Some things like Bitcoin, I at least think of as commodity. There are others that are very equity-like. It's a fundraising method. It's a currency hedge. It's potentially a method of resisting totalitarian regimes. That was one of the initial visions of Bitcoin, that it was an asset that people under a totalitarian regime could use to store their wealth in a way that couldn't be confiscated. There's tremendous value creation. This is going to be revolutionary. But many of these projects are on the wrong side of the Gartner hype cycle. So it is important to kind of maintain a level head. This time is different in that it's a new technology, similar to the internet or railroads. It is something fundamentally different, but market cycles and human psychology don't change. And so kind of bringing a level of skepticism and prudence and thinking about not just is this a cool idea, but is this a team that's actually executing, that's producing value for consumers, that's building something meaningful, and how can you contribute is kind of the way I'd approach it. Thank you. If you have time, I'm happy to take questions. Oh. Oh, yeah. I'm sorry. I didn't know if we'd have time, but I'm very happy to take questions. Yes, sir.
So in terms of the institutional investing, obviously this is very different than the internet in that it started with retail and as opposed to the internet, which is mostly institutional. So you mentioned the infrastructure as an issue for institutional money coming in. How does the market deal with the fact that when institutional money comes in, as a percentage of the size of the markets right now, it's going to move them significantly. So how does a Morgan Stanley or big investors deal with getting in slowly without completely moving the market in a way that's not healthy?
I think we're going to see extreme volatility for a long time. Both for that reason, the markets are extremely thin. And fundamentally, these things there is no easily quantifiable value. It's not like Microsoft stock where everyone's pretty confident the P ratio should be between 15 and 25. So I'm very confident Bitcoin has value. I can try to estimate it within order of magnitude maybe, and you might disagree. So the reality is I don't think there's a solution to that. What we see in practice is that hyper-volatility dissuades some people, but also produces a lot of greed, including among institutions. So institutions did plenty of equity buying in 1999 in the NASDAQ bubble. And I think during so the pattern that Bitcoin and crypto markets have followed has been kind of a boom bust every couple of years. I don't know if the current bust is over. I don't know when the next boom will be. I do expect that pattern to generally repeat. And during the next boom, when the asset class, so with a $250 billion asset class, a sovereign wealth fund can't say we want to buy 20 billion worth, right? You just can't. But when the next wave takes us to 2 trillion or 3 trillion, someone can say we want to buy 5 billion. It's not, you might move the market 5%, but that was true also of Google in its early years, or Yahoo stock. Yahoo stock was swinging 15% a day during the tech boom.
Earlier.
Yeah.
There are a lot of institutional quality funds out there. I mean, I guess there's like Paragon and others, but.
Probably not. So I say probably. So part of it just depends on kind of where you cut the line. So the real answer is probably no. Some of the leading funds are kind of brilliant young engineers or brilliant cryptographers who until very recently were literally working out of their apartment, for example. Most of those groups are now professionalizing because they want to manage more assets. People are going through the massive pain, including us, for example, of SEC registration to be investable to other more institutional investors who have a higher bar to meet. I think it's going to happen pretty rapidly in a year, let's say. But at the moment, the single biggest issue is any fund institutional if they self-custody? And the answer is no from the perspective of the institutions, right? However, you can dot all the T's, or dot all the I's you want, cross the T's. Like if I can walk away with the assets, it's not institutional. You're starting to get Wall Street interested. So the first wave of kind of traditional, let me phrase this differently. The early movers in cryptocurrency almost always were not the top tier in their field. because those people have too much to lose. If you're at the top of your field in something, you generally don't abandon that for a tiny, tiny asset class. And Bitcoin in 2016 was $5 billion, so you didn't have people leaving for that. So the same was true in money management, marketing. The best marketers in the world were not touching cryptocurrency 2 years ago because it was too small to be relevant. That's changing now. So now that we're at a $280 billion asset class, now you're getting the world's best people, including the world's best Wall Street people, who will bring that institutional quality management, I think, by the end of this year. Yeah.
So you mentioned the analogy to the early days of the internet, and you also mentioned that there's a lot of infrastructure that has to be built out. One of the things that I think has been surprising for us as we've watched the internet grow up is that it did disintermediate a lot of these central authorities, but then we saw decentralization in the likes of Google and Facebook and other companies. Do you see any opportunity for that to happen in this next wave? And if so, what would that look like, and how do we keep an eye out for it? What do we do about it, if anything?
Yeah, I'm not a utopian in this. So there's a lot of people who are like, same with the internet. It's blockchain's going to change everything. The world's going to be totally decentralized and totally open, and Facebook won't be able to sell our data, and totalitarian regimes won't be able to control their people. A very utopian view that that's just going to happen. I think what's actually going to happen is, like any technology, it'll be used for both good and evil. So China right now is working on launching crypto yuan, a cryptocurrency that is entirely centralized and controlled by China. So currency, most money is zeros and ones already. So what does it mean to have centrally government-controlled fiat? So it's the most Orwellian thing kind of you can imagine. What it means is that right now, the US government, the NSA, for example, could see all of your financial transactions if they went to the effort. So if they subpoenaed or used the right backdoors and they kind of aggregated all your credit card data and all your wires in ACH, they could do it. But you have privacy through obscurity. It's incredibly hard. If every single financial transaction you did was going through one database, it doesn't have to literally be one database, but right, government controlled. And if they could turn off your money with the clip of a finger, it's terrifying. That's going to happen. It is happening. China's launching it. Russia, many other countries. It wouldn't surprise me if the UK does it. Even the US Federal Reserve has talked about it because it's so appealing to the IRS, the Treasury Department, to law enforcement, to kind of everyone. That produces, I think, more demand for a decentralized alternative, which might be rendered illegal in many of those countries. This gets very kind of almost sci-fi-ish, but after China launches crypto yuan, they probably make everything else illegal, including cash, because why give someone else an alternative to the thing that you as the government can control? So I think that's the world we're going to live in. Like, Facebook's not going away. The problem is anything decentralized is slow and inefficient and expensive relative to a centralized version. And the centralized versions can have government backing that force you to use them. So I think you're going to have both. But that's still really, really valuable, in my mind at least. So the people who want to use a decentralized Facebook where they control their data, so there's a great project called Blockstack that's working on that. Blockstack's probably going to be a terrible user experience compared to Facebook forever. They're going to get much, much better, but it'll still probably be inferior. And so a lot of people will say, I don't care about my data, I want the better user experience. But at least for the people who want it, it'll be there. And for the people who want a safe haven, a Swiss bank in their pocket, it's very meaningful to me that even if it's only 5% of their assets, they actually have this safe haven.